Hi everyone, today we're going to be discussing a company that kind of hits on an awful lot of bigger picture trends. It's growing like a weed, it's got a clean balance sheet, and it's dirt cheap if they can achieve their guidance. And I've little to no reason to suggest that they won't be able to hit their guidance, and that's hopefully what we'll get across today. And given that, these guys are making a lot of their money from what ultimately was Obamacare, ACA, the Affordable Cares Act, the sentiment's very negative towards the company. And generally, when you have a well-performing business where sentiment's in the gutter, you tend to get just ridiculously good opportunities. And I believe that that's what's setting up in Oscar Health right now. Now, keep in mind, Trump and the Republicans just won in early November. They have a massive disdain towards what is Obamacare right now, but they have been talking about reforming it as opposed to just wiping the populations or those that are affected their healthcare away. And ultimately what I'm trying to say is it's still very fresh, and there is going to be a lot of volatility in the near term. But if we can look through the near term, maybe 1 to 3 years into the future, what does it look like? And it looks very asymmetric, and that's what's very exciting about Oscar Health. Okay, let's get straight into it. So Oscar Health Incorporated, ticker is OSCR. It's a high-growth disruptor in the U.S. health insurance market, leveraging its cloud-native platform, its customer-centric approach to transform the healthcare experience. So with its focus on ACA individual market, tailored programs for underserved demographics, and innovative offerings like ICHRA and the Oscar Plus platform, Oscar is poised for rapid growth. And we'll get into this in a moment, but both of those are also in some ways a diversifier away from ACA market as well. But we'll get into that as well. So Oscar itself, it's got, and we'll get into this now in a second because this is what is really exciting about the company. It's got industry-leading NPS, Net Promoter Scores. And that's basically, it's a qualitative sort of study on customer satisfaction, service, all that type of stuff. The higher the rating, the better the business is reflected within the industry. So that Net Promoter Score validates its differentiated strategy and highlights strong member satisfaction, providing a sustainable competitive edge. Now, if you go through their investor deck, they will show you what their NPS score is. Oscar Health as a company is 66, and Buena Salud, which we'll talk about in a moment, which I think is a fantastic way of approaching business, that's an Oscar program. It actually has an NPS score of 87. So that's a culturally tailored program. We'll get into that in a second. I went through a number of different qualitative surveys to better understand where the industry was at. And United Health comes in at 27 to 30 NPS score. Aetna, I'm not sure if I'm pronouncing that correctly, a huge acquisition that CVS made. 32 to 35, better than United Health, but far worse than Oscar Health. Humana, 30 to 35. Centene, 20 to 30. Cigna, 25 to 30. The industry average is 38. Now, these are some of the big public players. United Health obviously being the biggest with a $400 billion revenue run rate. So there's a huge amount of market to eat away at. I've got some notes here. So obviously Oscar Health far exceeds the general industry benchmarks of 38. And then the culturally tailored programs are just on a completely different planet relative to where the insurance industry is. Now that's got to do with the product itself. That's what's really curious to me is, okay, is it really dependent on ACA, the Obamacare? Is changes to Obamacare really going to affect the business to the extent where it doesn't make any money? I found that hard to believe just looking at its NPS score because the quality of the product is so much better than its peers. So you got United Health, diversified insurance. It's an industry leader, but it lags in customer satisfaction. That reminds me of a book called The Innovator's Dilemma. And the Innovator's Dilemma is like this idea of business is getting so big, bureaucracy ends up taking over, and there's small segments of the business that are inefficient for the massive incumbent. A new entrant comes into the market, focuses on that maybe lower margin, neglected space, and starts to innovate from the bottom up, stealing business to become the new sort of incumbent essentially. And when you look at United Health, huge business, $400 billion, but it doesn't have much customer satisfaction relative to a much leaner Oscar Health, which is scaling with a completely different strategy. It looks as though Oscar Health if the market wasn't to grow, Oscar Health could be stealing business and revenue away from companies like United Health just on satisfaction alone. So that's United Health, but Centene, I have it in bold here simply because these guys have a strong presence in the ACA market as well, Obamacare. So look at Oscar Health's satisfaction relative to maybe a close competitor in Centene. It's not even close. So their launch is up for grabs. Oscar Health and some of these culturally tailored programs are probably going to be able to advance upon Centene's market and steal some of the revenue, while maybe at some point in the future diversifying out. But as of right now, when you look at NPS scores to try and understand the product quality, it's far and away exceeding the insurance industry at large, but it's also looking at obviously its largest competitor, which would probably be Centene, and also United Health, which has got $400 billion in revenue relative to Oscar Health's $8.4 billion this year. So when I looked at NPS scores, I was like, well, relative to the industry, there's something differentiated here that's allowing them to grow as fast as they are, but they're giving off just incredible vibes for product quality. So let's get into that part. It's got a unique business model that addresses the challenges in the healthcare industry. So the whole point of Trump's cabinet going after Obamacare is because it's inefficient, cost-wise. There's an awful lot of challenges with it. And what Oscar actually are doing is solving a lot of the challenges that Trump's cabinet want to ultimately solve. And that's rising costs, low customer satisfaction, and inefficiencies within the industry. And we'll get into each of those in a little bit more detail. But that's ultimately what their business model is addressing. Everything that Trump's cabinet is going after. And so this idea of negative sentiment, let's sell off the stock, and we'll talk about just how much it's sold off relative to its peers. Yes, the share price is low. It's dropped maybe 30-35% off its recent high. But that doesn't show the extent of the drawdown in the multiple or the value of the business, because the business has been steamrolling ahead with 50% revenue growth this year. So let's talk a little bit about the company. It's technology-driven solution, and it delivers value through operational efficiency, so it reduces administrative cost. It's my view that the US healthcare system doesn't function properly because of administrative waste. Now, I've heard people argue that the US healthcare system is more expensive because the cost of labor in the United States is more expensive because it's more advanced economy. And that is total nonsense. That just doesn't make sense at all. If you can't be seen by a doctor, it doesn't matter how much it costs. That service, and I'm not saying it's that extreme, but when you take a step back and you listen to some of the problems that US healthcare has, it seems very much so that it's administrative waste that's ultimately clogging up everything over there. And so the first thing that these guys are focused on is efficiencies, right? So inefficiencies in the market, administrative costs. That's through automation and integrated claim systems. That's the first thing. The second thing is member engagement. So tools that enhance access, care management, and satisfaction. We'll get into that in a second because they're going after a market that is currently for profit and they are offering it for zero. And that's the telehealth market. And so that's a really interesting aspect where they're using telehealth, which is somebody else's business, and they're using it as a top of the funnel type feature for members. And then finally, affordable solutions. So expansion to small businesses and the gig economy markets with ICHRA. And that there is very exciting as well, because that's a mega trend as well. Gig economy and small businesses. People working for themselves on stuff like Fiverr or whatever it may be. That's a growing and expanding trend as well, and they're going after that. So there are three different areas: operating efficiencies, member engagement, and then affordability solutions. Again, we'll get into that in a little bit more detail in a second. We've got the different features that they have a little bit below, but just a high-level overview. So if we look at what they have and what they've done so far, so the ACA marketplace, it continues to grow. And Oscar ultimately, they're very well positioned to capture market share, improving margins, and then deliver long-term shareholder value. So if we look at lives now, market size in 2024 is 10 million. It's actually more. It's about 21 million. The market that Oscar is going after is 10 million. And they're looking to expand that up to 16 million by 2027, going after a bigger portion of ACA. Now, 16 million is the portion of the market with no subsidies. And if there is subsidies, it's closer to 21 million, but I just put in 20 because it's 20 and change. But with subsidies, there's actually 20 million lives. So the market could actually be double for Oscar Health into 2027 as they sort of sidestep into other parts of that market. Just look how much it's grown, though. In 2023, they had 967,000 lives that they were under the Oscar umbrella. That's 9.67% of their market. In 2024, as of Q3, it's 1.6 million, 1.602993 million. That's 16.2%. They're stealing market share off their peers. And again, you go back up here and you're like, okay, well, they're stealing market share. Why is that? Well, here's why it is, high-level view, and that's the reason. It's just much better offering than their peers, and you can see that through the NPS score. So that was very exciting to see. So what is the value proposition then of Oscar Health? Okay, full stack technology platform. So Oscar's cloud native platform integrates claims processing, care coordination, and member engagement into one seamless system. And this technology-driven approach reduces administrative inefficiencies, lowers costs, and enhances the overall market experience. The second thing is there's member-centric tools, so seamless digital experience, data-driven insights in the sense where the way they explain it is when you come, you put you put your details into their system, and they'll give you the highest value for the lowest cost, specifically tailored to you. That's what data-driven insights essentially means. And then when you become a member, you have virtual care, $0 virtual urgent care and telehealth options. So it's free. And that's for stuff like a new solution was for pulmonary care. They've got a diabetes care, like these chronic diseases. You get free telehealth options as part of your membership. And again, there are other businesses that charge for that. These guys are using it as a funnel to draw people into it. So it's cutting the cost, it's drawing more people into their ecosystem, and it's driving their sales. And they're able to do it at zero cost because the rest of the channel ultimately feeds into margin. They started off losing money. With economies of scale and growth, they get to profitability. And that's where the exciting part is once we get a little bit lower. So member-centric tools is also a value proposition that they offer. Targeted programs for chronic conditions. So Oscar designs plans specifically for members with chronic illness like diabetes, cardiovascular disease, and pulmonary conditions. Now, if you listen to Robert F. Kennedy, he wants to solve for an awful lot of chronic disease. And these guys are targeting that area as well. So there might be, I know there's an awful lot of hawkishness towards this administration relative to Oscar because it's in Obamacare market, but I think that's just a very sort of subjective, hey, listen, Obamacare, therefore bad. And I think there's actually an awful lot of solutions within Oscar Health that could solve for some of the challenges within Obamacare. Because remember, ultimately heading into 2024, and we'll get into some of the quotes in a second, but heading into 2024, Trump's cabinet were arguing for reform as opposed to anything else. Nobody wants to get rid of the coverage. They just want to make it more efficient. Oscar have those solutions in the areas that RFK was targeting. These programs include $0 costs for telehealth and urgent care, for key specialist visits, screenings, medications, improving health outcomes with lowering overall costs. Next up, we have simplified plan design. So Oscar's user-friendly plans feature clear, predictable cost structures, ensuring members understand what they're buying. Now, this is really important. Members understand what they're buying, how much it costs, and the value they receive. And I think that's a major, major, major problem within the healthcare, within the insurance space. Broadly, not just the healthcare space, but in the insurance space broadly. Insurance companies will have clauses and whatnot, just increasing their probability of not paying you out. And what these guys are doing is simplifying the paperwork so as you fully understand what you get. It's not like 200 pages of documents and clauses. It's quite simplified from everything that I understand. From everything I understand, from the way in which they explain it, it seems as though these guys are marching on a mission to make sure that members that ultimately buy a premium or become members, they know exactly what they're getting, what the value is for the cost. This is another one that I think is really, really, really interesting. It's cultural relevance. So if we go up here, just to show this again, Buena Salud, which is an Oscar program, has an NPS score of 87. Look at its peers. Look at Oscar overall at 66. This is a culturally tailored program specific to the Latino market. 87 on an NPS score. Relative to its peers, it just smokes everyone and everything. And these are new sort of features that they're rolling out that I think is really interesting. Buena Salud is one, Hola Oscar is another, and it addresses the unique needs of Hispanic and Latino communities specific to those markets. Tailored solutions provide a Spanish-first experience, improving engagement and satisfaction for underserved populations. I would say that this is likely going to be the first of many sort of tailored cultural type programs after the success they've experienced. But it's small sort of programs like Buena Salud that I believe is really going to drive massive amounts of growth for Oscar moving forward. To me, it looks like a fantastic decision. For example, just having healthcare options in the United States in Spanish, for example, Spanish language, it's going to be the first choice. I mean, if I look here in terms of healthcare options, I'd prefer English, obviously, over Spanish. But obviously, if I only have Spanish, I'll take Spanish. But if I had an English option, absolutely, I'd take it. And I'm sure many English-speaking expats would do the same, just on language alone. And so these guys seem to be looking at some of the challenges that the Latino and Hispanic market has, and they're focusing their attention on solving those needs. And again, relative to its peers, it's just not even comparable. 87 NPS score. Absolutely incredible stuff. And then finally, affordable and flexible options. So expand access to affordable health insurance through ICHRA, which stands for Individual Coverage Health Reimbursement Arrangements. So these options cater to small businesses and gig economy workers. It's offering flexible, budget-friendly plans that disrupt traditional group insurance models. 3 days ago, Mark Bertolini, who's the CEO of the company, was doing an interview, and he had said the future of healthcare in the United States is individual. It's not group. And so these guys are going after small businesses, and they're going after gig economy. And then eventually, going back to the innovator's dilemma, you've got the incumbent, very bureaucratic. You'll start going after larger businesses offering individual tailored programs to each employee. So it's a classic sort of innovator's dilemma type business, in my view. Let's talk about their growth drivers, because these guys are forecasting 20% compounded revenue growth from 24 into 24 into 27. So 14.5 at the midpoint billion in revenue, 8.3, 8.4 this year. So they're talking about 20% CAGRs on top line revenue. Where does that come from? So ACA Marketplace Focus, so that's the fastest growing segment in the health insurance space. So if you look at this here, they're currently going after 10 million lives. They're going to increase that to 16 and then possibly even 20 with subsidies. If those subsidies remain, maybe that gets replaced or taken out of the market. But even still, they're widening their offerings to attract more and more lives under that Obamacare sort of umbrella, which we don't think is really going to go anywhere. So that's one area. Outside of that, they've diversified a little bit away from ACA to provide more value, essentially. And again, we just spoke about this a second ago. ICHRA going after ultimately small business gig economy workers. So Oscar leverages individual coverage health reimbursement arrangements, ICHRA, to disrupt the traditional group insurance model. And this is why I think they'll win. This is why I think they'll just keep scaling with small businesses and gig economy workers first. So this is why I liken it to the innovator's dilemma. And you start off with a market that's not really important to the large incumbent. If you look at a business like, United Health, 400 billion in revenue. They don't care about a gig economy worker. That market is not that interesting to them. It would be more of a nuisance than going after a business that has, like, in the case of our very own, not Accor, the other one, Aptiv, 150,000 workers. That's more interesting to someone like, United Health than Oscar. So it starts off, the innovation starts off with these sort of smaller markets like individual workers and gig economy workers and small businesses. And then they generate enough profit. Their solutions are tailored and better quality, and then they start going after big business. So this has in my view, this has a very long-term, bright future because it's following the classic path of the innovator's dilemma. And so the first part is diversifying into their ICHRA expansion, and then the other part of it is the Oscar Plus platform is going to be licensed. So Oscar is licensing its technology as a service to external organizations outside of its core insurance business. So this allows other healthcare companies to use Oscar's tools for claims automation, care coordination, member engagement, cost management. So essentially what ends up happening is competitors become a revenue line item for Oscar. That's super exciting because as the market grows as a whole, and you have an NPS score of 66 and Buena Salud has 87, your peers are more likely to license your platform. You're going to grow as fast as you can, and you're going to capture the rest of the growth through your competitors by licensing the platform. So you're ultimately diversifying your risk by ICHR expansion and then ultimately licensing out the Oscar Plus platform. Those three areas are where we're expecting that 20% compounded into 2027. And again, in 2027, I think it's unlikely that we're done with growth. I think we just move on to the next sort of target, and that might be mid-sized businesses. Now we start eating United sort of healthcare's lunch. Right? Then it starts to get really interesting, right? You go from, today $8.4 billion in revenue to $14.5 billion to $50 billion to $200 billion, and you just keep eating away at companies like United Health. And so I think there's a long growth rate for these guys because of their unique offering, the way in which they're innovating from the bottom up, going after markets that are not that interesting from the larger incumbents, and the product offering they have is just tailored towards individuals, so it's got a better NPS, and it's not even close. It's got a better satisfaction rating. So let's talk about industry risks and mitigation. So when we look at risks, the rhetoric from Donald Trump and around the Affordable Cares Act is negative, with repeal and replace the main narrative of the first campaign in 2016. Let me just throw that in there in 2016. The company have positioned themselves to grow regardless of changes to ACCA due to superior offering that provides customers with value and satisfaction over industry peers. So regardless of what happens with ACA, these guys should still be okay. So the first risk is obviously policy changes in Obamacare. So how do they mitigate that? Will they diversify? We spoke about that a second ago with the growth channels, Oscar Plus, and going after gig economy workers and small businesses. Rising medical costs, they're mitigating that by expanding via cost management initiative and value-based contracts. So going back up here, simplified plan designs, they're going after value-based contracts. These guys can do it. The larger incumbents might have a harder time doing what these guys are doing because they've probably got an awful lot of liabilities that they need to pay for. Oscar doesn't have that. It's a cloud-native, asset-light type business. So these guys can offer much better value for money. And then competition, which does exist, of course, but quality we can say is measured by a high NPS score, and nobody's even close to Oscar. Not even close. Insurance industry average is 38. Oscar's at 66, and its closest peer, Centene, is anywhere between 20 and 30 NPS. It's less than half. And so when we're looking at sort of industry risks, there is competition, there is rising medical costs, and there is possible policy changes in ACA. And so they've mitigated to some degree, and that's what made me a little bit more comfortable. But we're buying a business that is, sentiment's very negative around it and valuation's very depressed because of those risks. Now, it's either an opportunity or it's not. I see it as an opportunity. Others may not see it as an opportunity. I think I'll win out. Other people may assume that I may not. But ultimately, everything that I've seen looks very interesting. So while the shares initially sold off post November 5th, Joshua Kushner, via his venture capital firm Thrive Capital, purchased 1.3 million shares through November, increasing their holdings by $18 million. So there's a duplicate, but it's just that, an insider, a co-founder, which is Joshua Kushner, he actually owns a venture capital firm. He was an initial investor, an early stage investor via Thrive. And just on that alone, it's quite unusual to see venture capital firms continuing to buy more shares after IPO. IPO is generally an exit mechanism for early investors. Like, we do an IPO and we sell it in the public markets. These guys are buying shares. So that says an awful lot in and of itself. Now, this is what's important. So that's the first part. The second thing that's also important is, Joshua Kushner is the brother of Jared Kushner. Jared Kushner is Trump's advisor, but he's also his son-in-law. And I don't know if you guys saw, but I think it's Chuck Charles Kushner was just appointed the ambassador to France. So that family is very much entrenched in US politics. They're a well-informed family. I'm not saying it's crony capitalism. I looked at the business. I think the business is fantastic. I don't think necessarily Joshua Kushner is buying shares because he thinks he's going to get a backhander off Trump because he's now president. I think he bought shares because the reaction from the market was, we're going to drop 10-15%. Trump is actually looking to make the industry more affordable. And Oscar actually have the solution. So you've got a combination of negative sentiment, cheaper valuation, and a solution to the problem under a Trump administration. And so I don't think it's crony capitalism. I think it's actually just more a reflection of what these guys think of the opportunity at hand. That's it. That's sort of the way in which I saw it. So I don't think it's crony capitalism. I just think, whatever it may be, I just think that these guys actually have a better solution, and you can see it through customer ratings, NPS scores. And that's ultimately why he was buying. But the main takeaway is he's been buying a lot of shares. Joshua Kushner owns 6.3 million shares via Thrive Capital. So they've got like a couple of percent ownership within the company. It's close to $100 million investment. It's about 3% of the company. That gets kind of interesting because now we're going to talk about the CEO compensation and shareholder alignment. So there is a link there if you guys want to go and check it out. Here it is here. It'll just show you the compensation, the different shares. The strike prices are between 11 and 39. But anyway, if you want to go through that filing, it's just a Form 4 to outline when he became, Bertolini became the CEO, that it was ultimately his employment contract and terms were uploaded into the Edgar system over at the SEC. So he's getting $600,000 cash salary per year. So I should actually say his name. His name is Mark Bertolini. So Mark Bertolini. He gets $600,000 cash annually, and he gets a target bonus equal to 30% base salary, and that, I believe that to be cash. So you'd be looking at somewhere in the ballpark of $800,000 a year if he hits his bonus in cash. So Mark Bertolini, which I should give you a little bit of insight, he was the CEO of another company in this industry, an incumbent, a pretty big business that was acquired for almost $70 billion by CVS. He was the CEO of Aetna, I think you pronounce it. He was the CEO of this. They got acquired $69 billion by CVS, and I think he left the company right after that. So he has industry experience. He was at a juggernaut of a company, and for years he'd been saying there are challenges within the market. He's very well connected. And so he takes over, but he's not just the CEO that used to be a CEO within the industry. He also used to be the co-CEO at Bridgewater Associates. So that's interesting because he's got capital markets experience and he's got domain expertise in this industry as a CEO. And he chose to take 600,000 euros cash, which seems like peanuts for somebody of his stature, and a 30% base target bonus. So possibly around 800,000 cash per year. Not a lot for somebody of his stature. Normally you get like 20 million or whatever a year. And that would be like broken down like 8 to 10 million in maybe cash, and then 8 to 10 million in stock-based compensation. Normally he wouldn't possibly go for a company like Oscar Health. It would normally be a much bigger incumbent, like a much bigger business than a $3.5 billion business, put it that way. but he chose Oscar Health. So he received equity grants, which will grant them as much as 10.32 million shares. Now, there's something interesting about Bertolini, which I might put in after the fact. I didn't put it in yet because I couldn't really corroborate it. There is, when he signed to become CEO, he has a charitable trust, and he's also connected to another partnership. And between them, the partnership, which I think is called Deerfield Partners, Limited Partners, and I can't pronounce his trust's name, but between them, they agreed to buy 5 million shares in the cash open market in that trust. Now, a couple of weeks ago, Bertolini went out and bought another 995,000 shares. So this guy has purchased almost 3 million shares with cash. So that's also very important. So he owns 1.5% of the company that he bought for with cash through his own personal charitable trust. Now, I don't know much about Deerfield Limited Partners, but they also agreed. They've got some sort of connection with Bertolini, but they also agreed to buy 3 million shares at the time in 2023. So 6 million shares have been bought in the open market connected to Bertolini. So first and foremost, this guy took on a role. He's taken a massive pay cut, and he invested a lot of money into the company. Between the two structures, he owns about 3% of the company. That's really interesting. And he takes most of his compensation in stock-based compensation. Now, that is a fat pitch. This is a guy that is looking at an opportunity, and he's swinging for the fences. He's taking a really, really fat pitch here. Now, if this guy is successful, he will make a lot of money. So let's have a look at this. There's restricted stock units, 2.866 million, and these will be 1/3 annually. So over the next 3 years, there'll be 900 and something thousand shares awarded to him just by staying as CEO. So he has to stay there for 3 years. Not over the next 3 years. This is from April 2023. But the vast majority of it is actually performance based units. And there's about just shy of 7.5 million shares. And they're to vest based on milestones. So the PSUs vest on Oscar Health stock performance over a 3 to 7 year performance period. And the share price has to be 90 consecutive days above the specific price in order to get paid out. So let's just pop on over here really quickly. So Bertolini, his first day was April, what is that? I can't see because the camera's in the way. April 3rd. That's his first day. Share price closes on the day at $6.75. So his first day, it was $6.75. This is where it gets really interesting, because let's just pop back here and have a look at this. So he agreed that 2.866 million shares would vest above $11. So not quite a double, but about 65% above the price, or maybe even a little bit more, above the price at which he started on his first day. And it would need to be above there for 90 consecutive days to actually be awarded the shares. The second is $16 and the third is $39. And so this guy made a bet where he doesn't get paid cash, but he gets filthy rich if he can take the company from $6.75 to $39 and stay above $39 for 90 consecutive days. And by the way, do that in sort of 7 years. He's 18 months into that sort of journey. He's already 18 months into that. There's 5.5 years left on that. So this guy made a really, really, really big gamble, because he's going to work his ass off, be scrutinized day in, day out about every single decision that he makes, and he might end up making no money at the end of it. But again, going back to his experience, he used to be the CEO of one of the larger incumbents, the $70 billion takeout acquisition by CVS, and he was also the co-CEO of Bridgewater Associates. Capital markets experience and domain expertise, decides to take all stock at $6.50 or $6.75, and they range anywhere from greater than 60-65% above where the price was trading to several 100% on the upside. To me, we've been in a situation where we've had the shareholders have been very aligned with the CEO. In the case of, came up in the chat, in the case of Zaslav over at Warner Bros. Discovery, and that didn't work out. Now, I think Zaslav made a mistake. Zaslav, from my perspective, decided to renew sort of networking contracts on the linear TV business at a time where advertising on linear TV was dropping double digits. And I think that might have been a mistake. Now, if you look at Bertolini, this guy came into a business that was doing about excuse me if I'm wrong on this. Oh, here it is here. It was doing $3.4 billion in revenue in fiscal year 2022. So he took on the company in April of 23. So the prior year, they done $3.4 billion. This current year, which is almost over, there's only a couple of weeks left, we're expecting top-line revenue to come in at $8.4 billion. So since he's taken over 18 months ago, the revenue has gone from 2022's $3.4 billion. It's been more than 18 months, a little bit more than 18 months. But it's gone from $3.4 billion to $8.4 billion. So he's doing something that's driving a ridiculous amount of internal growth. So we already have almost a 2-year track record of this guy as CEO. He's delivering tremendous results. And then all of a sudden you can start to realize, wait a second, now I can understand why he took equity, because he might get $800,000 a year. He'll get, let's say he doesn't get his targeted bonus, he'll get $600,000 a year. Let's say over the 3 years, he'll get $1.8 million. But if he's successful and there's a period of 90 consecutive days above $39 a share, he'll make $403 million. Now, we'll all be rich, but he'll be mega wealthy. And now I can understand why he decided to do it, because he had a product and a platform that was superior, domain expertise, and capital markets experience. And so the reason why I threw this in here is because, yes, it's not a guarantee that if the shareholder, that if the management team are aligned with shareholders, that the share price is going to explode, but it certainly doesn't harm us. And this is somebody that has domain expertise and experience. So it is something that I thought was noteworthy, and more so the fact that he's actually taken a $3.4 billion and he's delivering $5 billion more in revenue, more than 100% above, about 150% above where he first took over. That's incredibly impressive. Okay, so that is the business, a little bit of insights into the risks and also the management. Let's move on now and let's talk about valuations. So let's just talk about M&A. So CVS, we're familiar with this acquisition. I think it was $69 billion, but I threw in $70 billion because I just wanted to round it up. I wasn't sure. But CVS bought Aetna for $70 billion at 1.1 times revenue and 12 times EBITDA. Okay, there's not a huge amount of growth in that. It's a pretty decent sized business. So 12 times EBITDA. In the case of Oscar, when we get to their targets, and I'll outline what that is a little bit lower here, but when we get to their targets, these guys will, based on how their balance sheet is, they've got no debt, for example. Depreciation and amortization is incredibly low because it's not maintenance capex, it's more so growth capex. Their EBITDA their EBT, it won't be a million miles away from free cash flow itself. So if you kind of just look at that number, enterprise value to EBITDA, and just kind of imagine that says FCF, free cash flow, it's not a million miles away. So this is a business, the top one here was bought for $70 billion, not a massive amount of growth into the future in the sense where it's unlikely to grow 20% compounded, let's put it that way. And it's sold for, let's say, 12 times enterprise value to free cash flow. That's interesting. Cigna, Express Scripts, $67 billion, another big one, 1.2 times revenue, 10 times EBITDA, 10 times free cash flow, let's call it. And then Walgreens with Village MD, a much smaller acquisition, $5 billion, 1 times revenue, 20 times, let's call it free cash flow. So that's interesting. That's really interesting. The bottom one more specifically, because that's in and around the size of Oscar Health today. So M&A would be suggesting 1 times revenue, higher growth business like Village MD, closer to 20 times cash flows. That's kind of what the M&A market is kind of been projecting. More mature stuff with slower growth, 10 to 12 times. Smaller stuff, higher growth, 20 times. That's where the M&A market's been. So that's interesting. I've thrown in here, based on 2024's revenue guide and the 20% compounded growth rate targets, 2025, I should put I should rearrange this. In their presentation, they say they're guiding 20% revenue growth, 24, 27, and that's actually probably starting 25. It was the deck was 24. It was only a couple of months ago. The company would land at a midpoint of roughly 14.5 billion. If you look at sort of 8.4 billion compounded at 20% and so on, you're at 14.5 billion. Or 20 times free cash flow. Where do we get 20 times free cash flow? Will they also guide at a 5% operating margin? 725 million operating profit, 25 million operating cash flow, or 25 million in capital expenditures, 700 million in free cash flow. 14.5 billion divided by 20, 700 million, in and around that ballpark. 14.5 million at 1 times revenue would be 20 times free cash flow. Divided by the 246 million shares, or 49 million shares, in around that ballpark, the target comes in at 58.71. It's actually slightly different, because when I calculated this, it was before there was some shares that were actually assigned. So let me delete this, because I have it in twice here. I've done it again this morning. I didn't realize I'd done that yesterday. So anyway, that there is M&A. Just to give you an idea of what the valuation is. I've kind of thrown it in there, but we'll have a look at it now in a second. So, comparable analysis, right? So, during Trump's first term as president, he openly criticized Obamacare or the Affordable Care Act, calling it a complete disaster. When we consider the disparity from a price to revenue perspective, both ACA exposed companies, so that's CNC and Oscar, they're trading at depressed multiples. So here it is here. You look at enterprise value to EBITDA today on a forward-looking basis, 8.1 times for Oscar. It's a little bit lower because the last couple of days it fell. The other ACA focused company, Centene, 7.77 times. Both of those are much lower than its peer basket that are focused on Medicaid and Medicare. Actually, mostly Medicare. So the valuation is depressed right now. And I believe it's depressed because of this sort of hawkish tone towards Obamacare, ACA. That being said, Trump wasn't really running this term to terminate ACA. He actually showed an awful lot more ambiguity. And so if you listen to comments from J.D. Vance in November, he said, fundamentally, we're focused around the idea of fixing what was broken, not about stripping people's healthcare away. You're certainly going to see efforts to reform the system. And that's not something that we're looking to completely shut down and get rid of. It looks like reform, the exact word he's using. And then you had comments from Trump's team that said, President Trump is not running to terminate the Affordable Care Act. He's running to make healthcare actually affordable. And that was Caroline Levitt, and that was a spokesperson for Trump. And so the commentary and tone this time around, it doesn't really reflect the negativity that we saw heading into 2016. Yet the valuation of these businesses have been absolutely crushed. So when we're looking at comparative multiples, I mean, the fastest growing company in Oscar Health is one of the cheapest on an enterprise value to revenue basis and on an enterprise value to EBITDA basis next year, because they're already EBITDA positive this year, and they're going to see economies of scale next year with pretty strong growth again. Yet it's trading at the cheapest valuation. And the question is why? Depressed valuation, likely got to do with sentiment towards the Affordable Care Act. That ultimately gives you the opportunity. So when you take a step back and you see the bigger picture, okay, near term, a little bit of volatility. Longer term, what's it worth? So the guidance for 2027, here's a little table explaining it. They say $14 to $15 billion is the revenue target, and they're saying a 20% CAGR. Operating margins of 5% and a medical loss ratio of 80%. Right now it's at 84%, and margins should be breaking positive this year. I think we're expecting somewhere in the ballpark of 1.6% this year, but we're expecting operating margins to hit 5% in 2027. SG&A expense ratio dropping from 21% down to 16% obviously helps, right, from an operating standpoint. So we are seeing that they're the guidance that they gave. Now we can do pretty basic maths here, back of the envelope maths. So at the midpoint, revenue is $14.5 billion. They specifically said 14 to 15 billion. operating profit of 725 million at a 5% margin. That's their guidance on margins. Minus out your 25 million in capital expenditure, and the free cash flow comes in at 700 million. How do you get that number? Well, operating profit based on its margin, the midpoint, 725, minus your capital expenditures, you get 700 million. So what price is that $700 million worth? It's trading at 3.5 billion today. Is that fair? Is 3.5 billion fair for a business that's targeted to do 700 million in free cash flow by 2027? I don't think so. So at 20 times free cash flow, the company is equal to 1 times revenue and broadly in line with above peer comparisons. So in 2027, assuming targets are hit, these targets, the per share free cash flow is $2.81 at 20 times multiple, which is just looking at sort of this chart here and saying 1 times revenue, 20 times higher growth business. That's looking at M&A. So I don't think that's a stretch. I don't think that that's a massive stretch to say 20 times multiple on a business that's likely to do double-digit growth for years ahead. You're at $57 a share. $57 per share. So there was a little bit of dilution. Part of it was a payout for stock-based compensation for the CEO. Bertolini got 900 and something thousand shares recently on his 1-year anniversary, which wasn't included, and so on. So there was a little bit of dilution. That's the disparity between $58 and $57. It's not much disparity, but it's a little bit. That's $57 a share. So where are we trading today? We're not trading at 30, we're trading at 14. All right, so let's have a look at the chart here. We're trading at $14 and $14 today and 37 cents. So if you have a look at this here, I've got marked off Bertolini starts, company goes sideways, starts hitting operating leverage in 2024, and the share price just screams. First tranche, he got that 90 consecutive days above $11. He got that. He didn't get the second tranche, even though we reached a peak of $24 over here. We didn't see a situation where it stayed above 16 for 90 consecutive days. It was certainly up there for 90 days, but not 90 consecutive days. And therefore, he hasn't been awarded it yet. So he's got some dilution, but not all of it. And then the third target tranche, $39, is a considerable amount above us. So this is sort of how I was looking at it. There's 2 different ways. There's a black and a blue count here. If we look at the blue count first, both of them are similar targets in nature. If we look at the blue count, this would be a wave 1, a wave 2, a wave 3, a wave 4. Remember that wave 4 would be a triangle, so it wouldn't be overlapping with the wave 1. So you have a 4 and a 5. So that would be all of a wave 1 of a bigger degree. Pull back in a wave 2, 1, 2, 3, 4, 5 for a wave 3, ABC here for a wave 4, that would have completed here. And then your fifth wave would be equal to your wave 1, which finished up here at $9.92. It's 377%. That gets you up to $57.91, which is in and around where we think the fair value is if they hit their targets in 2027. The other count is, if we were to look at this, we'd be looking at this as a wave 1, 2, 1, 2, 3, 4, 5, 4, and 5. Now, if we were to mark that out, off this wave 4 low, equal to wave 1, you're up 207%. You hit just a little bit above $39. You pull back to the 38.2% Fibonacci at 26.41, and then you go up another 201%. You're at $78. Okay, you're not entirely in the same area. That's the difference between 100% on the current price. A little bit more than 100%, but it's still in the stratosphere, and the risk versus reward, in my view, is fantastic. So I'm actually looking at a target price around 57 for this, and it might be the case that we bottomed and we start running here over the next couple of years up towards that target of 57. But I think that the risk versus reward here is incredible, and I think you've got a situation where you've got very negative sentiment, which might persist a little bit longer here, but you've got very negative sentiment. You've got a solution to the problem that's being argued on the healthcare situation. And so you have a product offering that's loved by the market, that solves an awful lot of the government issues, and it's growing like a weed. fundamentally sound and solid. From a balance sheet perspective, net cash position, the dilution risk is really only stock-based compensation. So everything fundamentally is pointing north. The chart also stacks up as another pillar, and I think these prices will look silly in a couple of years. So my expectation for Oscar Health is that this thing will trade at 20 times free cash flow into 2027. They hit their targets, and you're looking at $57, $58 a share. Now, if I pull up a calculator, right now, so if we take 57 divided by 14.37, it's almost a 4x from here. It's incredibly asymmetric. And so I think that the odds here are pretty damn good with no balance sheet risk and an awful lot of positive growth in the channel. So this one, to me, looks very exciting. And so as we move forward, this would be a company that I would continue to dollar cost averaging into. So as of right now, the expectation from a chart perspective would be the low at 13.19 is in, and we would be expecting continued upside.